Yo, what's good YouTube? Welcome back to the Concentric Circle channel. Today we're going to be going over options levels and gamma exposure. I know that this is becoming a lot more relevant in the trading space, so I wanted to get a video out for you guys on this. I did upload a video very similar to this on my personal YouTube about a month ago, but I wanted to put this content out on this channel for you guys. So yeah, without further ado, let's get right into it. So when options traders place large bets, market makers usually take the other side. And because market makers do not want to hold a limited directional risk, they hedge by buying or selling the underlying asset to stay delta neutral. So that hedging can create real buying and selling pressure in the market. And this goes beyond just drawing boxes, things like that. Okay. So in this video, I'm going to go step by step on how you can actually use options pricing and gamma exposure to find levels, and find key areas in price to look for reactions. So we're going to go over things such as spot price, call wall, put wall, vol trigger, max pain, how to actually plot those levels. We're going to use QQQ for our example and show how to actually find bias in respect to those things. So the first thing we have here is this paper that I have written, which goes into options pricing, and I will leave a link to this down below. And the first thing we should understand about options pricing is gamma, okay, and hedging. So gamma basically measures how quickly delta changes as the underlying asset moves. And gamma is important because the delta is not fixed. As price moves closer or further from an option strike, the options delta changes, meaning as a dealer must hedge against this change, okay? So the main theoretical section I want to focus on is the fact that if a dealer is hedging an options book, the price starts to move, the dealer's delta exposure also changes. And because of that, the dealer may need to adjust their hedging. And that hedge adjustment can mean buying or selling the underlying asset, which is what is actually going to create moves in the markets that we are trading as day traders. So we can look at this right here, this equation here. And what this basically is saying is that hedge demand changes based on gamma, which is the change in price, and the number of contracts and the contract multiplier. So in simple terms, when the gamma is high, small price movements can force larger hedge adjustments. And that is why options positioning matters for traders, because it can help explain why price reacts at certain levels, why price can pin near a strike, or why price can accelerate once a level breaks. Now we can get into actually looking at GEX and gamma exposure. So first we should understand why GEX and this pricing matters. So options are not just random side bets placed on the market. They actually create exposure, as we've said. So if someone buys a call, someone else is usually selling that call. And a lot of the time the other side is a market maker or options dealer. So this dealer does not usually want to just sit there with unlimited risk, so they hedge because they make most of their money through commissions and spreads, right? They don't actually make most of their money by being directionally biased. So this chain is basically options positioning creates dealer exposure, then the dealer exposure creates hedging demand, then that hedging demand creates buying or selling pressure, and that buying or selling pressure can affect the price of the underlying asset. So we will get into, right here, we have a QQQ chart, and we have levels for GEX for April 27th, which will be the example that we'll go over. So I'm trying to look at this, right, and find our levels. So we have, our walls, max pain, and we also have the open interest for calls and puts. Okay, so that's going to be the basic framework of what we are looking at here. And you guys can easily find this information through Discord. I get all my GEX information for free using this server GEXBot, which I will also leave a link for. Okay, but yeah, let's get more into the delta and the exposure. Okay, so if an option has a delta of 0.5, that option behaves like it has about 50 shares of exposure because one standard option contract controls 100 shares. So the delta will tell us how sensitive the option is to the price of the underlying, and the gamma will tell us how fast that delta changes. So gamma is especially important near expiration because short-dated options obviously have higher gamma and will have a higher impact on an intraday chart. So this means as price moves closer to a major strike, dealers may have to adjust their hedges quickly, and that is where options can start affecting actual price movement more. So if we have a positive gamma, that means that dealer hedging usually has a dampening effect, and that means that price movement can become more controlled. If price goes up, dealers may sell into that strength, and if price goes down, dealers may buy into that weakness. And this is going to create a more stable and choppy environment with a lot of mean reversion. Okay. Now the opposite is to be said about a negative gamma. In a negative gamma environment, dealer hedging can amplify price movement. So if price goes up, dealers may need to buy in more, and if price goes down, dealers may need to sell in more. So this is going to be more volatility and more of a rally trend type of environment with less clear support and resistance. Okay, and this will be seen on days where we break through levels with speed and continue to rally or spool for the rest of that day. So now that we have seen the GEX server to find this here, let's actually break down what I'm going to be looking for and how I actually read this chart. So spot price, very simple. That's just the current price of the underlying asset, where QQQ is currently trading at. So that right now is going to be 663. I'll make this a little bit bigger for you guys. Okay. Now we see that we also have a major wall at 663. And we have our call wall also sitting at 663. We have our volume trigger sitting at 662. And then our max pain at 657. Okay. So what I'm going to do is mark all these levels on my chart, which I've already done here. So call wall, put wall, volume trigger, and then max pain. So those will be the plots that you will want to set for the day. Okay. Now, the volatility trigger is going to be important because this tells us where the market may shift regimes, right? If price is above the volatility trigger, the market may become more stable and controlled, which is exactly what we see here. As price comes above this, we get a rapid expansion above, and then we see pretty controlled, stable action following price being above that, right? We also see as we approach the call wall, which is going to be our main target for calls and longs on this day, and our main resistance, we see price begins to slow down and kind of just chop around this area as a mean towards the end of the day. Now we have our max pain right here sitting at 657, and what you'll see is that as we open for the New York session, we come immediately down into our max pain and get instant rejection followed by a rally leading to our call wall, right? And we know that as price is opening, it's near our max pain. All of our other dealer positioning levels are above us, right? So put wall, vol trigger, and call wall are all positioned in these low 660 areas. Now, after we see a reaction like this, we can likely anticipate we are going to see higher prices for the rest of the New York session. Okay. So besides the levels given here, I want to look at the actual bars of open interest distribution on this chart. So on the right side, we have the call side gamma, and on the left side, we have the put side gamma. And the size of the bars shows where options positioning is concentrated, right? So you see as we have like these walls here, this is where we have the highest concentration of positioning. Now, this can tell you that there's a lot of open interest at these places, and this can matter in a couple of ways. So if price is below those levels and the market is in a more positive gamma environment, those call heavy strikes can act like resistance or pinning zones. But if price accepts above the call wall, then those higher strikes can become upside magnets or rejection levels. So this will show us where the market has concentrated options exposure. And the bigger the concentration, the more likely the level matters. So these are going to be less significant down here, right? Because there's a lot less concentration at those levels. So now let's talk about actually building a bias. So we understand that the spot price is around 663 here. We have our wall at 663. We have our put wall 662 and our max pain at 657. So immediately I know the most important zone is between 662 and 663. That's going to be a large decision zone for price, and also where I can expect price to become more controlled and start to slow down. Okay, now like I have just said, right, if we open down here and we are nowhere near where we have this concentrated options positioning, it is heavily likely that price is going to visit those areas, correct? Because we need to visit those strikes, right? And so that makes bias, as far as this day, very simple. Okay. Now, how could we frame a anomaly in this case, right? A situation that doesn't necessarily follow by the acceptance we would expect, right? Let's say we were to come under this max pain and continue pushing lower, breaking through this, and then retesting above and seeing failure to accept higher. We would then have an anomaly in price where we would maybe expect more bearish conditions, right? However, we got a very expected signature in price here, which is our max pain supporting us to trade to those higher strikes. Now, what we can do here is look at how we can actually transfer these levels into trading on the futures market, because I don't actually really take options positions all that much. I typically use this data to actually execute through futures, right? So let's say we have market open here and I am long biased. I understand that we are likely going to see bearish manipulation after the open to come down and test this max pain and resistance / support. Okay. Now I'm looking to see us reject off of this, as we've said, and I'm looking to see us rally higher. Now I'm not necessarily looking to enter off of this immediate rejection, because there will be some discorrelation between the QQQ and futures chart. But this is where my bias is going to be confirmed after seeing that we see buying pressure come in off of this, right? Now, as far as after this, you can do something like take OTE of this range that was created here and look for your 0.706, which is right here, to be respected, and then see we spool higher off of that. And look for something like a close above this to then look to take a trade, right? Back into your volume trigger, and ideally your call wall would be your target for the day. And once we hit that call wall, I mean, this is straight chop, right? You're not missing out on much. I mean, we had a few more points that were given, and you could have just, trailed stops throughout there. But typically call wall is going to be a great target. And on this day, I wouldn't continue to be buying in because we see this rejection. It's not like we really broke through this with intense volume. And so we're kind of pinned at this spot in price. Now, I want to make this very clear, right? GEX levels are not magic, and they're not going to predict every single move. However, they do show you where options positioning is. They show you where dealer hedging may dampen volatility, and they can really give you a clear overview of what to expect on price for the day, right? If we have, a lot of volatility, right, with the negative gamma, we're going to expect more of a spool. Whereas if we have that positive gamma, we're going to expect tight range bound behavior. So understanding what kind of moves to look for, understanding when to take profit, and if it's a day where we can be holding runners. And so these things are going to help you execute a lot more clearly, especially in the futures market, and kind of avoid some of the noise near the open, right? Because you know exactly where you're looking for and what areas you want to see reject, okay? So the main takeaway is that options pricing and game exposure can give you a hidden map of the market that overall candlesticks or even order flow tools will not. Delta tells us directional exposure, gamma tells us how fast that exposure changes, and the GEX chart helps us find levels where dealer hedging may matter. In this example, 662 was a key support and volatility trigger, 663 was the call wall and upside decision level, and 665 and 68 were upside gamma targets, which we had here, right, where we still had high positioning, right, understanding that price can potentially reach those levels. And instead of coming into the session guessing, we now have a full plan of where we want to execute from and what we are looking to see at each of those areas in price. So that's how I use options positioning to build my market bias and trade within futures. If you want to learn more about how we use this inside of the concentric circle, you can join the free Discord down below. But please stop trading random setups, actually learn the model, study these things, and collect data. Thanks for watching.